I lost $243,000 on a single gold short Strangle. And in this video, I want to go over the exact position statistics, the entry and the exit rules, or the reasons to be more specific, and also the graph analysis and what's going on with the position currently. My name is Eli. I'm a professional option trader, and currently I manage over $8.7 million. So let's get right into the video. So the GC short Strangle position, I closed it for a loss of 40% of credit. And here you can see all the position statistics, 86 days to expiration, the strikes. You can see that it was opened on November 2nd, and my fill price per contract was 23.5. Take profit was at 50% of credit, and I would roll or close the position at negative 50% of credit, depending on the news. Obviously, I ended up closing it for a loss of 40% of credit because of the news. Now, the position size was 3 contracts per every $100,000. So it's about $7,000 in premium, so 7% of capital, and margin impact was 29,000, so 29% of capital. So when the position was open, the trend was not clear. It was a possible consolidation, and volatility was good, obviously, when the position was open. So I was quite okay with opening or looking into a potential position. Now, there was no critical reason for the price to increase or decrease. So, and there were no critical news at the time. It was in the midst of the government shutdown, but there were really no reaction. There was no reaction from gold for the government shutdown for almost 35 days. So for me, there were no critical news. And as you can see, if the answer is no for each and every question, it's a short Strangle or a short put for me. And I chose to sell a short Strangle on this position. And let's continue on. So the closing P&L, like I said, is negative 40% of credit, and the loss is $243,000 or 2.8% of the total capital I am managing. So the loss itself is not too big. My average profit is also it's closer to the 2.3%. So it's basically I lost what I make on an average trade, give or take. And the trade duration was 7 days. Now, why did I decide to close the position at a negative 40% of credit? And these are the different reasons, or the new fundamentals at the time of closing the position. So now there was a critical reason for the price to increase, and the reason it was the speculation of the U.S. government opening and releasing delayed economic data to support a December rate cut. And as we know, a rate cut is very bullish for gold. So just on the premise of the US government opening and a potential release of delayed economic data that can support a December rate cut, the price shot up like crazy. Like it was a massive one-day move. And we'll go over the graph in a second. So it was really, really abnormal. And at that point, I decided to just close the position because this is not a healthy position to be in, right? Because at that point things became really uncertain, the news became critical, and for me it was just a reason to close the position, not to roll anything anywhere, because I don't really know what's going to happen or how is it going to happen. So it's really important, and this is my first loss since since my previous loss, which was 20 months ago, right? So a year and a half ago, or over a year and a half ago, was my previous loss. And it was also on unexpected news. It was on copper, right? So here it's also something really unexpected, and I have no way of foreseeing, obviously, what's going to happen or how price might react to certain news, but I can react and close the position for as little loss as possible, which is what I did in this case. Now let's go over the graph and let's see what's going on right now with gold and what I think will happen, and more importantly, what's going on with the position right now, because I still have it opened on a demo account. This is the position as it looks like visually, the strike of 3,400 and the call strike of 4,700. So you can see the range was very, very big, and I chose the bottom strike just because it was closer to the bottom of the side channel. And then the top strike was just an equal distance strike the same distance. Basically, the price was at the time from the short put. Then I just kind of chose the same distance to the short call. So my short put was the deciding factor for my strike selection, and then the short strike was it was followed because it was equal distance as the short put. Now I opened it on Sunday when the market opened after 6 p.m. and we don't have a Sunday here, so it's labeled as a Monday. And basically price was okay up until Friday. So the first week of the position, it was up almost 30%, which is very, very good. And then on Sunday, we had the news that the government might reopen. And on Monday, the price just shot up 2.79%, which is quite a lot. And even if we look at this entire rally for gold, this historic rally, this would have been the third or the fourth biggest day for gold. So, and it's past this entire rally, right? So this was a massive move, like a massive move for gold. And as you can expect with a move like that, volatility expanded. And I just decided to close the position because the news are critical, things have changed. And at this point, if I hold the position, it's just complete and hope, right? And volatility is expanded too quickly. Now, the position got to a point where it was down like 200% of credit at the very height of the price move. Right now, currently, it's sitting at down 10% as I'm making the video at this very moment. And it's been kind of bouncing around from minus 70, minus 60, minus 40%, minus 50% again. Now it's minus 10%. So it's been bouncing around. The position was slightly positive when the price kind of came down here. It was maybe plus 2, plus 3%, but still it's been, from that point, it's been almost 20 days right now, a little bit less, and it's still not profitable, right? So some people would kind of stay in the position, hope for the best. I don't work this way. I don't find it profitable. When things change, fundamentals change, you have to be able to adjust or close the position. In this case, I closed the position because I don't see a very clear opportunity right now with gold because we don't know what's going to happen with the rate cuts in December. Currently, the probability of rate cut is really, really low. I think it's under 40% last time I checked. But at the same time, we still have some delayed economic data that's been released. And today, as I'm making this video, we had some economic data for September and we are in November, right? So we still have possibly some economic data to be released regarding what happened in October for the economy, for the US economy, right? If there's any economic data there at all, if they collected anything, because the US government was shut down basically. So they might have not collected any data or not enough data to be able to release the reports for the month of October. So I just don't know what's going to happen. And in situations like this, usually the option seller has a much less probability of making money, at least making money without a lot of P&L fluctuations, which is exactly what can happen. So the price will shoot up just a little bit, the position goes down back to minus 60-70%, right? So it doesn't take much for this position to go bad because volatility is really high at this point. So this is it for this video. This is the loss I took. It's just part of the business. You just need to make sure to keep the losses small. This is really abnormal. Things like that happen, and there's really no good way to prevent it without, I guess, kind of influencing your performance overall. So far on this year, I'm up 24%. Pretty happy with it, given the year, and this is the only loss I had. And it is what it is. We'll continue forward, and we'll wait for better times, and we'll be able to capitalize on more opportunities as they come, and they always do. So thank you again. If you have any questions, let me know, and I will catch you in the next one.